Hello and welcome to the Mutual Fund Show. I'm Niraj, Shah, and over the next 20 minutes or 25 minutes, we'll talk about 2 or 3 key topics around mutual funds. Some data crunching, some back testing or looking at the historical returns and trying and figure out what's happening. And of course, there are some queries that have been given by our viewers, some of you, and we'll try and answer some of those. Our guest today, Deepali, founder and CEO of Sujan Financial Services, and Nikhil Kothari, who is director of Etika Wealth. Deepali and Nikhil, thank you so much, both of you, for taking the time out and being with us on the show. Really appreciate your time.
Hi, Nikhil.
Hi, Deepali.
Great. Okay, let's try and talk about the first topic and the data that AMFI as well as NSE have put out seems to suggest that share of passive funds are rising in the overall MF assets. Now, we know for a fact that if you take a look at the last 5-year or 10-year history, passive funds have outperformed at least the large cap category. Some data suggests even the mid cap category, but let's stick to the large cap category for a while now. And the share of passive funds are rising. So my question, and I'll start off this with you, Deepali, is that if somebody wants to put in money in the large cap category, and there are a lot of people who are advocating that move money from mid caps and small caps into large caps, is the passive fund route the better route to invest in the large cap space?
I think so. Passive funds routing the large cap exposure of your portfolio through passive funds does make sense, because I think the information dissemination is across quite uniform through various research outfits in the large cap, less amount to be discovered, so to speak, as surprises, and therefore in a large cap index fund with lower expenses versus an active managed and the lower cash component, it does warrant one to have a decent exposure of large cap allocation to index versus actively managed.
Nikhil, is your view different?
Yeah, so the view is similar, but I'll just say that, see, when you're comparing, right, you are normally comparing with a TRI when you're comparing active managed fund. Now, TRI is not an investment universe, right? Because the thing is that when there's expense ratio, there's a tracking error, and so on and so forth. So when you're comparing to a large cap active fund, we should be comparing with the index fund, and then the ratio, the number which we are highlighting may be slightly lower. That few active funds would have outperformed the index fund as such. Now, so that's the one philosophy. Now, the second thing is that I'm saying core part of your large cap portfolio should be an index fund, but you can have 1 or 2 active funds which are slightly more concentrated bets. Because at the time, what happens is that when you take a concentrated, so in large cap, the only way you can outperform the index is to a large extent that when you take concentrated bets, and then if the fund manager really does good, he can generate alpha on that. So core part of a large cap portfolio should be index, and 1 or 2 active funds you can take it as a part of your portfolio, but that should be more of a concentrated bet depending on the fund manager's view and the fund house view.
Okay, but the core part of the portfolio should be the index, which is the passive way to do it. So are there any favorites first amongst equals within that universe? It seems to be a straightforward yes from both of you, and I'm sticking to the core part of the portfolio as the large portion of your answer, Nikhil. So are there some favorites out there that people should keep an eye out if they want to use the passive route to do the large cap investing?
See, in large cap investing to be very simple. When you're doing a passive, there's nothing called as a favorite because all are same funds in them. Now, the only thing is again in large cap, there are 2 different universes. One is a Sensex 50, and there's Sensex 30, and there's a Next 50. So there are 3 different categories, right? So now, when you're taking a large cap fund, Next 50 will have a slightly higher volatility as compared to Sensex 50. So when you're doing the passive, I will normally recommend that you can divide into both the things, because both are comes under universe of large cap, where you can take a Next 50 also as well as a Sensex 50 also.
Deepali, usually there is at times when there is not much to choose between firms as well, people still have a first amongst equals. I'm just trying to understand. I heard Nikhil's answer and he was correct. Do you have a favorite though amongst the passive fund?
Not really actually, because it does have very little differentiation, and also that keeps changing. So, an index fund with a low tracking error, with a lower cash component is what you should look at that point of time to go for.
Okay. Fair call. We are moving tracks a bit. This seems to be a straightforward answer, so we are moving tracks a bit. Viewers, here's the point. I urge you to do your own research about whether large caps can give you a better bang for the buck versus mid caps and small caps. It would depend a lot on your time horizon as well. If you are convinced, though, that you want to either invest into large caps or move a part of your mid cap or small cap portfolio into large cap based on your own study, then the passive route might actually be a good route. Historical performance suggests that, and our advisors also have said that that might not be a bad idea either for the core part of your portfolio or even for your overall portfolio. So it's the first topic out of the way. Then a SPIVA report suggested, the data suggested that ELSS funds have actually performed extremely well relative to the universe, which is BSE 200, S&P BSE 200, which is usually the universe at which they are compared with. Nearly 30% or nearly 70% of the ELSS funds over a 5-year period have outperformed that index. Now, at a point of time when large caps and to an extent even select mid-cap funds are struggling to beat the index, here's a category which is beating the index quite handsomely. 70% beating the index is a big thing. So my question, and this one I'll start with you, Nikhil, that while ELSS funds are usually thought of only and only from a perspective of tax saving, can the forced staying invested measure in ELSS funds, because you can't sell them ahead of 3 years, make them a good candidate for non-tax saving investing as well?
Okay. So first I'll say that ELSS as a category is a great category. Since you are logged in for 3 years, I'll say investor experience, right, will be very, very good because you are by default, you're logged in for 3 years. And if you're doing SIPs, effectively your last installment, by the time you can withdraw the full amount will be 6 years. So as a category, investor experience will be very, very good in ELSS. Okay. So, and because it's a 3-year lock-in, so you have a good time frame to stay invested. But do I am a firm believer of that? The answer is no, because I always believe that the money should always be available to me when I want to redeem, right? And should be accessible to me. So I normally don't recommend logged in products apart from the tax saving, which we need to do in ELSS, because that's how I'm comparing with the PPF. And over a 15-year period, ELSS will outperform PPF hands down. So for a non-tax saving instrument, I'll say that there are a lot of large and mid cap fund, and there are a lot of multi cap fund would have also outperformed BSE 200. Right, so it's not only ELSS universe, but BSE large and mid cap fund and multi cap funds have outperformed BSE 200. If I take a slightly longer history, so I will recommend that if you're not looking for logged in investments, then I'll recommend to be an open-ended fund. But ELSS as a category is a great investment, I'll say, because from an investor perspective, if you don't have any control over your emotions, and if you don't have, then ELSS as a category makes sense. But I'm not firm believer, because at this time I'm against tulips also. The reason is very clear that I don't want to lock in my investments. I want that money should be available to me when I want to redeem it, and I should not be locked in by any fund manager or any fund house.
Deepali, I'll try and rephrase the question a bit as well, and this comes from how people who've invested for long in PPF, for example, right? They may not have had to do so, but people have put in money in PPF at the end of the term, which is 15 years or extended period by 5 years or further 5 years. This forced saving habit at times keeps them disciplined, keeps them invested for better returns. So my question is, and I take on board Nikhil's answer, I mean, if you have choices, why lock in? But does the lock-in actually help performance, because the fund manager knows that the money is there for 3 years, and is that probably a reason why so many of the ELSS funds as a category are outperforming the benchmarks, and should therefore, even for non-tax reasons, should they be considered?
Okay, so I'll answer this question in 2 parts. While I completely agree with Nikhil that money has 2 functions to serve, liquidity and returns. And why should I hamper liquidity if I can get commensurate returns from an open-ended? Right. Now, coming to the second part, I don't think the lock-in gave superior performance. Now, since we are comparing it to benchmark you mentioned, that is largely a large cap benchmark, and most of the ELSS currently are holding flexi cap portfolios. And the fact of the matter last year was that mid and small cap clearly outperformed large cap by 20%. We have seen outperformance of ELSS because the benchmark you are comparing it to is largely large cap. And on the investor behavior, I completely agree with you, Niraj, that I think it does make sense to nudge the investor to keep it locked in, because this forced behavior does represent at a later stage a higher net worth versus the tendency to pull out because you can. So even when the markets are bad, you may not be able to cut out the noise, so you may pull out. And when the markets are good, you could be tempted to book profits, which could let you forego future profits as and when. So while I principally agree that largely most investments should be liquid, hands reach away, but in the ELSS case, I would, to nudge people to have a longevity of their holding capacity, I would say that they should use ELSS even when it's not for tax saving. So for other long dated investments for equities, yes, ELSS is a very good tool.
By the way, viewers, one way or the other, by this questioning, I'm not indicating that you as a viewer, or I don't think either Deepali or Nikhil are indicating that you as a viewer or as an investor don't have control over your habits. But if you are that kind of investor who gets tempted to book profits once the market move up over a period of 6 to 12 months, whereas the long-term staying invested might serve you better, then maybe, just maybe, ELSS might be the right thing for you. Bear that in mind. So I think if you see here, the dichotomous answers from both our experts, they take into account in some fashion investor behavior. And if you know what kind of an investor you are, you might be able to better use ELSS schemes or otherwise for your investing. Having said that, if you are tempted to invest into ELSS schemes, at times, by the way, viewers, it's great to start your tax saving from the month of April for the whole year, as opposed to doing it straight in the months of Jan, Feb, March, just before the year is ending. So for both these reasons, let me ask our experts, what are the kind of ELSS schemes that might be that they like within that? Deepali, can I ask you, I mean, this will not be an exhaustive list, just an indicative 1 or 2 ELSS schemes that you like.
Okay, so you could look at SBI long term, you could look at DSP tax saver, to name the couple of them.
Okay, and remember, viewers, these are not the only ones, but a couple of indications coming in from Deepali. Nikhil, maybe a couple of things from your end. Let's assume, because you don't say that they should be used for normal investment purposes, but for tax saving purposes, they might be a good. Then for tax saving purposes, a couple of schemes, and why do you like them?
So basically, I'll give you, I use ELSS from pure tax saving, and my whole family's investment goes in tax saving in ELSS.
Okay.
And I'll tell you, I've come from a place called Jorhat, okay, which was recently covered in Economist magazine, where that they have every household has a SIP more or less there. Right. And there we do a large business in ELSS, because normally ATC is the one, I'll say, carrot for everyone to start investing in mutual funds. So we have done a lot of investments in ATC in the native place of Jorhat. And I'll normally do is the DSP tax saver. And recently we have also started doing Parag Parik tax saver, because with the philosophy, we like that fund house philosophy. And historically we have done DSP tax saver as one of the scheme which we have invested a lot of money there.
Okay, sorry, would you just repeat before we hit that break, Nikhil? What is the name of the place that you spoke about?
Jorhat. So it was recently covered in Economist magazine, right? That I'm saying if you try to locate at your end, you will hardly find a place called Jorhat, right? It's a city in Assam. Okay, it's a very tier 4 city. Okay, and personally at our house, we have 160 crores of EUM from a place called Jorhat. Okay.
Wow.
If you really go and do a survey there, most of the household will have every household will have a SIP there, right? And this was covered by the Economist magazine recently.
Well, who says investing in India is restricted to the metros and the larger cities? This is quite fascinating a statistic. I'll look up that article. Let's try, because there are so many queries, let's try and take a couple of them at least, and then we'll maybe talk about the third topic. So the first query is from Mohammed. Mohammed is aged 22 years. The goal, well, is guidance. Interesting. Okay. Mohammed says that I have 2 lakh rupees in savings and would like to start investing in mutual funds. Can you recommend me some funds? Nikhil, I'll start off with you on this. It seems that Mohammed, young chap, but doesn't have any investments in mutual funds currently. He's got 2 lakh rupees. I'm presuming that he wants to do a lump sum and then may want to continue in SIP. That's an assumption on my part. For now, I only know that he's got 2 lakh in savings. Any thoughts here, Nikhil?
Yeah, so I'll say that first of all, since he's 22 years old and it's a long-term money, he should be purely equity funds. Now, since markets are slightly overvaluation in terms of expensive, then I'd rather recommend instead of doing the one-time lump sum because he never invested in mutual funds, I recommend him to do a STPs over next 10 months so that he can withstand the volatility which can happen over next 5 to 6 months because of election. So I'll recommend he can initially start with two funds. One is a multi-cap fund which will give him exposure to large mid-cap and small cap, which is Kotak multi-cap fund, and one is a flexi cap fund, which will be Parag Parikh flexi cap fund. He can do 1 lakh investments in either arbitrage fund or a debt fund and start STP over next 10 months. So that over next 10 months, all the money from debt or arbitrage fund will go to equity funds. And additionally, he should keep on increasing his SIP. He should start SIP and then keep on increasing every year on year. And this will, I'm saying over next 20, 25 years, he can create a large portfolio with this.
Mohammed, I hope you got your answer. We have a lot of queries, so I can't really ask Deepali for your answer, Mohammed, but Nikhil has given you a very nice answer, so I hope that helps you. And we need to move on to the next query. That's coming in from Rushabh. Now, Rushabh is aged 31 years. Rushabh's goal is a retirement fund. Everybody in that age bracket currently thinks of retirement. Very interesting. Now, Rushabh is saying that he currently has SIPs. Okay, I'm quoting him verbatim. I currently have SIPs in 6 funds and would like to retire by the age of 51. He can additionally invest 3,000 rupees in new funds. Which funds would you recommend? His current SIPs are Parag Parikh Flexi Cap with a 4,500 rupee amount, Nippon Small Cap 5,000, Quant Small Cap 2.5, HDFC Mid Cap 1.5, Mirae Asset Large Cap 2.5, and Mirae Asset Mid Cap 2,500. Deepali, too many funds, too much data, I know, but if you could get a gist of what I was trying to ask you, what would your advice be?
Yeah, so I think he has 6 funds, which to me is enough. He need not look at others. Second, I think his small cap exposure is quite high in terms of percentage. So he may not want to reduce the current ones, but he can at least try and see that he chooses a, let's say, SBI large and mid cap for the either if he's wanting a new one, or he could add on more to Parag Parikh Flexi Cap, his additional 3,000.
Okay, so Deepali, but your advice seems to be that he doesn't need to invest in a 7th fund, reduce the small cap exposure and use this money in the Parag Parikh fund.
Yeah.
Got it. Okay. So Rishabh, you seem to be on the right track. Just make a few alterations here and there, and the additional corpus can be put in, as Deepali suggested, into the Parag Parikh fund as well. Now, let's move on. And before we get to the third query, but the third query is kind of related to the topic that we wanted to bring out today. There's a lot of talk about moving to large caps, so on and so forth. Now, if traditionally, when mutual funds have underperformed an index, the subsequent years, it has happened a number of times that they've managed to outperform as well. Typically, when an index does really well, fund managers find it difficult to outperform that index. So my question, Deepali, I'll start off with you on this one. After having a period of significant underperformance, if you will, relative to the index for a better part of 2023 and maybe a couple of months of 2024, can mid-cap and small-cap fund managers actually outperform the indices over the course of the next 12 to 24 months? And is that a good reason to stay invested in small-cap funds or start SIPs in small-cap funds?
Okay, so why don't I just step back and kind of throw light
Sure.
on the broad logic, so it'll be easier for people to decipher on their own. An index is made keeping largely the market cap of companies and the liquidity of stocks, whereas a fund manager is expected to build his portfolio based on the quality of those stocks and growth which he expects in those companies which he holds in his portfolio. Now, at times, things may not converge. And especially in the last 1 year, where we had seen so much of momentum, we got some 41,000 crores in small cap segment and 23,000 crores of rupees in mid cap. So in such laughing your way to the bank kind of markets, each and every stock tends to go up, irrespective of whether they are quality or not. So last year has been quite an aberration, and a fund manager who is looking to buy quality stocks need not be able to be close to an index, whether mid or small, and also he has to maintain cash for redemptions, and he has a higher expense in connection to a index or a benchmark. So with those things in mind, a momentum market and the fact that his common list may not be as per the index, and he's having a higher expense ratio by at least 75 to 80 bips, and higher cash component which is not getting deployed for redemption reasons, it is normal to see a fund active managed mid and small cap in such one-way markets to underperform a benchmark. With that perspective in mind, what I would suggest, based on client's risk appetite and whether his goals are at least 7 years plus, one should, some simple thumb rules, but please refer to your professional, whosoever you're seeking. Mid and small cap component can be of the equity portfolio can be 20 to 30%, and the balance can be in the large cap. Where the fulcrum of this lies will depend on your advisor.
Okay.
That's my broad thought. So
Sure.
nothing stark which has happened, it's expected. So therefore, we need not take stark reactionary moves, but keep in mind our asset allocation, our risk appetite, and our advisors' recommendations.
Got it. Nikhil, your thoughts?
So I'll just add to Deepali's point. So one was cash component, but apart from that, what we need to understand when you're looking at small cap index, it only has small caps, right? But when you're comparing a small cap fund, it will have small cap exposure, but it also have a mid cap exposure, it also have a large cap exposure. Now, if you see all the three indices, the small cap has given 76% return as compared to large cap, which has given, like, say, 25 to 30% return. So the difference is 40%. So if the small cap fund has some amount of large cap and some amount of mid cap, he will bound to underperform the small cap index, right? So because small cap fund can never have 100% money in small cap because he has to manage the liquidity. And that's why the SEBI came out with the stress test that whether the fund manager will be able to liquidate his portfolio when there's a redemption, right? So fund manager has to manage the liquidity also. So whenever there's a one-way bull run, a small cap fund, an active small cap fund will always underperform a pure index. Most of the active managed fund will underperform the index. But if you look at last 1 month, when the small cap had some correction, right, many active managed fund outperform the small cap index. So I'll say that, see, market will never be a one-way direction. Markets always have volatility. So if I take a 7-year picture when there will be some volatility and there's some downward markets, at that point of time, the active managed small cap fund will be able to outperform the index. And over a long period of time, if you look at it, because when you're looking point to point, the 1-year return makes a huge difference. But if you look at rolling return over a long period of time, many small cap active managed fund would have outperformed the index. So I'll still say that active managed funds in a small cap segment makes sense. Now, allocation to small cap depends on your overall portfolio, how much you want to have, depending on your time horizon, depending on your risk appetite. You can have a small cap active managed fund in your portfolio. And 2024 may not look like that we'll have a continuous one-way rally. So if it's not a one-way rally, then I think many active managed fund will catch up with the underperformance what they had in 2023.
Well, from an investor's perspective, cross fingers for that and more. I wish I would have taken the query, but really out of time on the show. So we'll have to wrap it up here. Nikhil, Deepali, thank you so much for taking the time out and being with us on the show. Really appreciate your time.
Thanks so much.
And viewers, with that, it's a wrap on this edition of the Mutual Fund Show. Stay tuned. Lots more coming up on NDTV Profit.